Now we're going to pivot into the U.S. And one of the things that we wanted to look at is something from the macro bond Nordea guys. And I happen to agree with them. And the reason why I agree with them, we'll have that data behind it. But when you look at the USA GDP first estimates and current estimates, you can see that there's some shifts down. And when you look at the way the US GDP is and then what their model is showing, it's in a contraction. And one of the things is, does it come in at negative 2%? Probably not, just because it's always going to come down to the consumer. And the consumer has started to slow. It's finally negative and it's starting to roll. And the question is how the rate of change. And the rate of change of that number is going to dictate how far negative do we really go. And is it negative 1%? Is it negative 75 basis points? I do think it's a negative number. And it's important to look at what are some of the key drivers of that. And one of the key drivers is investors, and this is, again, where equities is continuing to try to grasp onto, is that the Federal Reserve isn't going to cut rates. And the idea is that that rates are going to, their expectations are that rates are no longer going to be cut in 2023. You could see it's continuing to shift over, and more people are expecting 2024. And I think as for those that have been following us, our view was that rates were going to be elevated for 12 months. From the point of stopping forward, they were going to be elevated for 12 months. And you could see that view was not held by many, but as the year progresses, it's getting more and more palatable for this to be the case. Given where inflation is, given where the market sits, they have to do something. And that's why even Q1, I think you're going to see that, again, continuing to slide into the next piece in general. So now when we look at U.S. deposit rates, not keeping up with other cash options, that's a problem. When you look at the 6-month T-bill, you look at the money market mutual funds rates, well, why would you be in a bank deposit rate if you can get 4.5% somewhere else? And that's where there's that gap, which is going to have to, if realistically, if banks want to attract deposits, you're going to have to pay higher rates. But the question is, who can pay the higher rates? Because in order to finance those higher rates, you have to be able to go earn those, which they can by investing in T-bills and some other things. But what about the loans? What is your bad debt expense? So how much money do you have to keep on the books? And how much money do you have to deploy for new loans to businesses? And those new loans will be at higher rates because rates have gone up. So that will help not only cover your margin, but and what you have to pay. But again, it's a catch-22 because do you need new loans to support the savings rates, or do you need the savings rates to get in the additional money to then give it out in loans? And the Fed funds rate can kind of bouncing around a bit can cause some deviation in that, because when you look at the curve, as we've been saying from 1 week ago to this week, we've been very consistent. So if you were watching our chart, it would not have any fluctuation up or down, because it's like, guys, they were never going to cut sooner. I don't care what you think is happening. They have to keep going up given the inflation backdrop, especially when you look at core CPI. So now when you look at the New York Fed recession probability in 12 months, it's up to 60%. But more importantly, when you look at the U.S. leading economic index, so the LEI, or the leading index, came in at negative 1.2% as of March, negative 8.8% annualized over the last 6 months, 7.8% over the last 12 months, which it's nothing new, but it's just further evidence that a forward-looking perspective shows a much slower economy. And when you look at yields and when you look at all of these different things, you're seeing the pressure point to the downside, and you're seeing some of these pressure levels, which is why, again, that U.S. leading economic index is just telling us that there's a lot of problems out there, which the fixed income market has kind of sniffed out and continues to show in terms of the differentials or the inversions in the rates, where equity markets is a bit just kind of going sideways. So now when you look at the what kind of institution do you use for your primary personal banking needs, and 31% announced, and again, it's just 2,000 respondents, but it gives you an idea of where people are. 31% use national financial institutions, 26% regional local financial, 21% credit unions, 11% online. So again, there's still that exposure to that regional local financial institution. And even though there was that panic, there's still not a huge panic in general. And so when you look at these different levels, you have to say, okay, well, is there going to be a bigger run on a bank? Is there going to be more concern? Or did we pass this and now it's a new problem? And one of the things that we've looked at going back in 2006, or I should say into 2008, Bear Stearns went belly up and the market rallied for 6 months before the next kind of shoe dropped. So the question is, where do we start to see this, and when? Because we do think that there is a credit risk. We do see it as a systemic problem, and that's going to cause bigger issues. So then you look at U.S. credit conditions and loan growth. So the index is based on the Fed SLOs, Dallas Fed credit conditions, and the small business surveys. And you can see that on a percentage basis, that the credit conditions are much worse, which means that it's harder to get loans. So if it's harder to get loans, it means that banks aren't lending, so they're not getting higher rates. So then the ability to then go out and increase savings rates becomes more difficult. And then you get this shift of, okay, well, do people start to move? And that's going to create, again, a constant, I don't want to say fear, but a constant like little dagger kind of hanging over people's heads of, well, what comes next? Because it's not fixed, but what is broken? What part of this is broken, and how do we correct it? So then you look at deposits. So all commercial banks going back, you can see that it has a small bounce, but it's not to the same degree. And a lot of this is because it's moved into money market funds, because people are sitting there, it's like, all right, I can go make 4%, or I can go sit and make 50 basis points. I'm going to go make 4%. And so when you start looking at deposits at small and large chartered commercial banks, you can see that there's still, there was a perpetual drawdown of large banks. And everybody likes to show some of these different levels, but look at the separation, right? So you got a bounce in small banks, you got a bounce in large banks, but it wasn't an equal level because some of that just disappeared from the deposits level and it went into something else. And the small bank side, it's not something that we see coming back too aggressively at this point. It'll stabilize, but we do think that there is going to be another event that will take us lower. And it's interesting when you look at it as of April 23rd, because going back to March, and this is why some of these surveys are good to understand where people's mindsets are, but you can also show how black swans exist, because essentially they don't see it coming. So bank credit crunch and global recession wasn't even on the docket in March of 2023, and now it's the number one issue for April of 2023. High inflation continuing to be an issue. Systemic credit event is now a less of a problem, but again, it's more of a reclassification because bank credit crunch creates a credit event. So realistically, they're saying the same thing. It's just a matter of, what is the domino that starts that piece? And, one of the things is the credit crunch is the one that we've been talking about for those that have been following us, that credit crunch is the problem where you can't get credit. And as you start to try to roll credit, as you try to move things, you have the inability to do so, creating those problems. So then when you look at the U.S. bank lending has pulled back of late, down $105 billion in the last 2 weeks in March, but the 4-week percent change isn't yet consistent with the max pain territory seen in prior recessions. So it's coming down, but look at it from a gross level. And you could see from the perspective of, even that little tiny recessionary period, it's ever so slight. So the question is, well, how far down does it really come? Is this something that is going to be more systemic when you look at 06 into 09, when you see that there was a sizable drop? Obviously, COVID had its own little problem, but then there was a quick snapback. This is something where we think it starts to meander and actually come lower and surprises a bit to the downside, which is going to be a bigger problem when we look at the liquidity factors. So then when you look at the shifts in the 30-year mortgage rates, they're still volatile, but they're volatile in a window. They're still at 6.24%. And our view for those that have been following us is that we stay around this 6 to 7%. Does it average 6.25, 6.5? That we can debate. But this range of 6 to 7% is very stable at this point, and you'll get gyrations within it. But that's where we see some of the bigger pressure points and why those prices have to come down to reflect those increased in cost. And another key piece is when you start looking at the New York Fed survey of consumer expectations. So as the consumer expects higher inflation, they're going to be less likely to pay up for housing. They're going to be less likely to pay up for stuff because they are concerned about what that's going to cost in the future, and they're going to squirrel money away to try to protect against that. So the New York Fed survey of consumer expectations, percent saying it is much harder to obtain credit versus a year ago has started to go up. Percent saying it is somewhat harder to obtain credit versus a year ago is back to the highs that we saw at the beginning at over 40, at close to 45%. So again, it's still somewhat harder, but our view is that you're going to get a bigger consistent move of people saying, well, it's not just somewhat harder, it's much harder. Like, I can't get what I thought I could. And if I do get it, it's at a lower, a higher interest rate and a less principal that was given to me. So when you look at it in terms of the different shifts, then you look at the U.S. financial conditions from Bloomberg, recently fell at a rapid pace. 30-day change was most negative since the pandemic, but didn't have as severe of a decline as in the past couple of recessions. And then you had a bit of a bounce from the trough. And that's the whole thing is you had some panic, you had a recovery from the panic, and now people take and assess. And the assessment is, I think when you look at the fixed income side, is telling you that there's more pressure to the downside. And that's why you're seeing the fixed income market showing that breakage where you're not getting the same type of fear from the equity side. Then you look at the misery index, combines unemployment rate and year-over-year CPI inflation rates. It fell swiftly, now at 8.5%. As of March. So again, you're still seeing some of this pressure going back through time. But again, with CPI coming down and unemployment still being very underwhelming and well below full employment, you're starting to see some of that adjust to a point. And that's why it's like, okay, some of this is bad. The leading index is telling me it's bad, but now some of this is okay. But it's why we look at so many different factors, because unemployment is a demographic shift. We don't have the same demographics we did in the 70s, in the 30s, so we're not going to have unemployment to the same degree that we have in previous years. It physically can't happen to that level. And now, so that's why you have to kind of adjust that misery index, because we're not going to see the same type of pain even as we get pain on a different level, because we're the most indebted as ever before, the most credit card debt as ever before, and that has issues as rates continue to ratchet higher. And combined, the Fed discount window and the emergency bank term funding program has eased for the fourth consecutive week, but the U.S. banks had a combined $139.5 billion in outstanding borrowings through April 12th. And now it's down from 148, but there's still this panic that remains. And if you look, going back to COVID, the levels that are being used today are very elevated. And if you go back to 2006 to the 2009 period, we're still at record levels now than we were then. And the mentions of liquidity in the Fed Beige Book are going up. So there's lending volumes and loan demand generally declined across consumer and business loan types, and several districts noted that banks tighten lending standards amid increased uncertainty and concerns about liquidity. Liquidity is you're going to hear this term nonstop. And the question is going to be, how much liquidity does a bank have? Because if a bank has an increase in bad debt expense, they have to keep some of that cash on hand to offset, which means that even though they technically have that cash available, it can't be put to work. And as that grows and as deposits fall, that gets tighter and tighter, and you get leverage ratios that can ratchet up very quickly, creating some of these stress points. Now, the bank collapses in early March prompted traders to go from pricing the Fed rates from 5.36 to 4.75. And again, it's back to 5.04. 5.25% to 5.5% is where we're going. That is where we will be. We are going to get that 25 basis point increase. And on an intraday basis, the 3-month U.S. Treasury yield has taken out its early March high before bank implosion and is back to the highest since 2007. And again, this is the concern that we keep having, is that the the fixed income is telling us there's a problem, but yet you're starting to see the equity markets that are just kind of lackadaisical. It's pretty out right now. It's like, well, what are we focusing on right now? Like, what is happening at this point in time? And that's why we think that the fixed income market is more right than wrong. And now in Q1 of this year, 11.4 billion of bonds were downgraded to high yield status, which is about 60% of 2022's full year total. Full year volume is on pace to be the highest since 2020. Notably, banks also expects pickup in the number of rising stars companies upgraded to IG. So we're going to get some of these shifts. But this is going to be the concern, because if you remember back in 07 and 08, you had ratings go from AAA to junk essentially overnight. And this is going to be an important one to watch of how are people or how are companies evaluating these key pieces. Then you look at the MOVE index, which is the volatility of bonds. So the volatility of bonds is telling you there's a problem. It's at 124. It got up to about 135, 136. And you can see it's staying at the highest level it's been at going back to the late 80s. And the only way in previous times to bring this down was QE or some sort of cut in interest rates. And we're just not seeing that the ability for banks or for the Fed to be able to do that. So why is it that bonds are panicking? Bonds have this insane volatility, but then you look at equities, and equities, the volatility is falling and falling in a rapid way. Which is why when you look at this, it's like, okay, well, who's right? Equities are saying that there's no volatility, there's no issue, there's no fear. And bonds are saying, well, the fear isn't as bad as the week ago, but it's definitely not back to normal. And this is saying something very different, which is why we think that there is more concern in general. And one of those key pieces, and we'll go into more detail as we go through the remainder of the next segment, another big piece of that is the inflation remains the largest issue for small businesses. So small businesses are still concerned about inflation, quality of labor, and that is going to be a perpetual problem. It's not the same level of issue, but it's still one that is real and hitting them in real time, which is why the Fed is, again, kind of stuck. And then when you look at, the US EU commercial real estate side, the most likely source of the credit event. So fund managers see commercial real estate as the most likely source for a systemic credit event. And US shadow banking, I don't think that's the biggest concern. It's really that US corporate debt and really the commercial real estate market, because the commercial real estate market worked because of ZIRP or zero interest rate policies. And now that is gone, you're seeing more and more stress on that. We've seen defaults, we've seen bankruptcies, you've seen the inability to roll this debt, and it's going to become a bigger and bigger problem, which is why the real estate pessimism has risen to 2009 levels. And it's a little bit different. Like in 2009, it was on residential real estate, and now it's on commercial real estate, which are sizable and a big nugget of a risk for these especially small and medium banks and these regional banks, which were the largest writer of this debt, and really accelerated in 2020, which is why we see some additional pressure points here. Now, when you look at the small business optimism index fell to 90.1 versus the estimate of 89.8. The outlook was unchanged at negative 47. Hiring plans, expectations for higher sales, easing of credit conditions, and compensation all deteriorated. So again, it was a broad sweep of negative coming from the small business optimism and small business surveys, which again is just layers on more of those problems and risks that we see. Then you look at the surprise. So April Empire Manufacturing Index surged to 10.8 versus the estimate of negative 18. New orders jumped from negative 21 to 21 to 20 to a positive 25. Shipments went from negative 13 to positive 24. Prices paid continued to move lower, but work week is still contracting. So it's kind of this is where it gets interesting, because it's like, well, why? Why did we get this pop? And why did it happen in April? And is it something that other areas are going to confirm, or is this something that's an event specific to the Empire area? And that's going to be an interesting one to focus on, because the prices paid component within the Empire fell in April to the lowest since Jan, while the 6-month forecast for price paid increased. Not a huge divergence, but again, it's off the peak. And that's one of the things that we've been saying, is that it's going to come down, but it's going to flatline. And then it's going to start to bounce around. And that's what the forward market is telling us, because April also picks up the change in OPEC. So that's when you start to say, it's like, okay, well, things got better now, but based on what OPEC did, based on commodities here, it's actually going to go back up. But not up to where it was. It's just going to see this. And that's where, again, more of that support for that inflation side. But then when you look at the Empire State Manufacturing expected new orders, it started to come down, and it didn't really bounce. So that's where there's some contradictory pieces in it. And one of the things is the leading indicator still showing some of that downside pressure. And then you layer on the Philly side, at which came in well below estimates, and you start to see it's like, okay, well, maybe this was a bit more of a one-off, and then prices paid, as we've been saying, has continued to drift a bit lower. Now, the New York Fed services prices paid came down, still at the highs going back through 2005. New York Fed services prices received coming down, but again, still at the highs. So more of that stagflation, we see this again leveling off. And then when you start looking at the U.S. industrial production, so year-on-year percent change in industrial production continues to soften, came in at 0.5, which is consistent with prior recessions. But again, worth noting that there was a much slower growth in 15 and 16. And if you remember in 15 and 16, when we thought we were going to get something, that was when China just went, balls to the wall with stimulus and essentially averted that, which as we will talk about in segment 5, we don't see that happening again. March industrial production came in at positive plus 0.4 versus the estimate of 0.2. But factory production came in at negative 0.5, and utilities came in at a positive 8.4, with utilities really being the driving force behind it. So again, you're still getting that industrial production on a downward trend, not this huge drop, but you can see starting to roll over a touch. Now, service businesses activity index from the New York Fed edged up slightly in April to negative 9.8 versus negative 10.1 in March. Business climate worsened, employment fell to zero, prices paid receded, and wages ticked lower. The 6-month outlook dipped into negative territory, but CapEx remained improved. So it's like, okay, well, one side is going down, and one side is coming down, the service side, which is the bigger piece of GDP. But the manufacturing side surged. So again, what matters more? It's services. Not as bad as it was expected, or not as bad as it was. But again, you're kind of getting the stabilization, and that's why we think the Empire piece is a bit more of a one-off and not really a change in direction. Small business optimism update showed a net 9% of respondents said financing was harder to get compared to 3 months ago, most since December of 2012. So you're seeing people, getting harder and harder to get these credit and credit conditions deteriorate in general, creating more pressure points. All the while, the latest update from the New York Fed shows average reservation wage, what a person would be willing to accept for a new job, rose to just under $76,000 in March, which is an all-time high for the survey. And again, it's because people are looking at a new job and they're saying, well, my costs are going up. Therefore, if I'm going to accept a new job, I have to get a higher wage. And that's where we keep seeing some of this turnaround. Now, look at the Empire Manufacturing new orders component surged in April to the highest in a year. Given the fairly tight relationship with the ISM Manufacturing new orders, are we going to see this across the board? And the Philly Fed is telling us no, but we're going to have to wait for some of the other Fed data to say, okay, well, maybe the Empire was a one-off and it won't be to that same degree, which is why when you now look at the Philly Fed, the index fell to negative 31.3 versus the estimate of negative 19, contracting for an eighth consecutive month. Employment improved to negative 0.2, up from negative 10.3. But again, new orders rose from negative 28.2 to negative 22.7. So again, it's better, just it's contracting less, but it's not improving to expansion, which is why we continue to see some of these pressure points. And again, that's not something that is going away anytime soon, creating some of these, again, perpetual problems that we keep seeing. So that's what we have for you on the fixed income side. And again, just to kind of, I guess, round up, the fixed income we think is more right than the equities, and why we think there's going to be more pressure and again, earnings recession, if you will, that's going to pull down some of these equity numbers. And the fixed income side, I think, has always kind of proven to be more right than wrong. It's much bigger than the equity market and has more juice when you think about who's going to drive what. So in the next segment, we're going to talk more about inflation, especially core inflation, and how is that impacting kind of what the Fed's going to do and where we see things going over for the rest of the year.